Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting on the low time frame with the bearish scenario where we're looking for either a WXY or an ABC where B or X is already in, or expect another high to be made for B or X where the maximum target is the 1.38 sitting at 46.1k, taken from the high to the low of W or A, which is in confluence with this golden target box over here for some additional resistance sitting between 45.2k and 46k, which also means taking the double top that I have on my chart. If wave B or X is in, we are looking for a move towards the downside, where for a wave C, we then want to see an impulsive structure to the downside, a 5-wave move, and for a wave Y, we can expect a flat structure, a zigzag structure, or a triangle structure, which is of course yet to be seen. If price does move to the downside, we do have support besides the double bottom over here for potential swing failure type of move. Grab the lows, close above, move back towards the upside. We also have the yellow box here as support, 38.6k to 39k. And on our way to the downside, we do have some other additional support as well. In this range here, we have a daily at 42.2k, failure area low of this range at 41.9k as the point of control moved to the upside from previously down here to now being up here. And then we have a daily and a daily naked point of control at around 41k as well. Now in the bullish/bearish scenario, we are here still looking for a move towards the upside first. However, this could be the end of the bigger trend where we're then looking for a much deeper retracement, or this diagonal by itself can be another 1, 2 and continuation to the upside for then a bigger wave 5, right? Where this wave 4 is finished, 1, 2, and then we're looking for a 3, 4, 5 to the upside, where then your wave 5 is going to end all the way over there. Now here, we are then looking for the end of wave 4 after a flat, A, B, C. Wave 4 here is in, and this move to the upside is then an ending or leading diagonal, where the waves are zigzag structures. A, B, C, wave 1 finished, corrective structure in 2, which also has to be a family structure of the zigzag family. And then we have another zigzag in then 3, looking for a zigzag in 4, and eventually a zigzag in wave 5. Wave 2 here retraced to the 786, taken from the low to the high of 1, which is a common target for wave 2. And for a wave 4, preferably, a price retraces to the 0.382 to the golden pocket area, taken from the low of 2 to the high of 3, which is between 42.9k and 41.8k. Now something you also see is the 1-to-1 on my chart over here, taken from the low to the high of 1 to the low of 2, which means that this wave 3 is longer in price than wave 1, which, considering the new rules of a diagonal, does not invalidate a diagonal, but it is still not common. Now the new rules of a diagonal say that in even a contracting diagonal, wave 3 is allowed to be longer than wave 1, and you don't need overlap between wave 4 and wave 1 as well. So this is still very valid. It's still a perfectly fine diagonal. It's just not common still, right? It's still rare for a wave 3 to be longer than a wave 1 in a diagonal structure. Also, if we look at the volume, preferably, this is a guideline, not a rule, preferably volume moves towards the downside as the diagonal is forming. But you can see we have quite a high peak of volume over here in the high, right, or around the highs, this area inside this wave 3, much higher than we had in wave 1, which also means we do have to at least consider the possibility of continuation in a 1-2-1-2 and then continuation to the upside, purely based on the volume pattern that we have, which is then also this scenario over here. Wave 1, wave 2 in green, higher degree Elliott wave count, right? 1, 2, 3, 4, 5 is the higher degree count, and then inside wave 3, you're looking for a lower degree, 1, 2, 3, 4, 5. Now, a lower degree Elliott wave count, preferably, is shorter in time and price than the higher degree Elliott wave count, meaning the second wave 1 and the second wave 2 preferably are shorter in time and price than the first wave 1 and the first wave 2. The second wave 1 in this scenario would indeed be shorter in both time and price compared to the first wave 1. So that's nice, but you can see that the second wave 2, being the blue wave 2 here, is much longer in time compared to the first higher degree wave 2. Now, an explanation for this could be the way of the corrective structure, right, or the corrective structure itself. Here we then have a zigzag, tends to be short and deep in like by nature, and then here we're looking for a complex structure in a WXY scenario, which tends to be also a shallow retracement. So this could still be a double 1-2, even though wave 2 is very, very long. But of course, it's weekend now. And what are the probabilities for a wave 3 in the weekend? Usually, they're not too great, but we at least have to be prepared for the scenario that if price takes the high, we might see continuation to the upside. It's all about being prepared. If we look at the 886 over here, I've been talking about this 886 since the first moment it got touched over here. So we've been talking about it for a few days now, of course, taken from the high to the low over here, where the moment an 886 is touched, probabilities increase that any move to the downside is a C or a wave Y. But the moment you hit the 886 for a second time and then a third time, probabilities really increase for price to not go all the way to the downside first, but first take the highs that we then have over here. So that is then also from an Elliott Wave perspective, because this 886 information comes from the Elliott Wave theory basically. Probabilities now are higher to take these highs over here in comparison to probabilities of moving to the downside and the lower end of this range. Now, price does like to retrace towards the golden pocket after an 886 touched, which happened once, which arguably happened twice here and maybe 3 times. We didn't yet hit it. So, of course, possibly we could still take the double bottom that we now have here and then move to the upside. We also have a bit of an order block here on the 2 hour, as you can see, right, the red candle. So there is a bit of support still below, but the probabilities of the 886 would suggest at least seeing a move to the upside. If you look at the CVD divergences, we have the bigger bullish CVD divergences where the target is that high. Locally, we had bearish CVD divergences, but these have played out as price took the low, so that is very nice. We now have the bullish CVD divergences here locally as well as here. So if price would move to the downside, these ones are going to be invalidated, but this one is then still active, where the invalidation would be price moving below this order block over here, which would increase probabilities of moving to the downside. But at the moment, of course, we are here. Now, we did have, compared to this low, an 886 retracement here locally, right? But because price has been ranging for a long time, this could be a WXY, and then you're going to be looking for a move back towards the upside, right? Instead of this being the low of a B or X and then a C or Y and then a move down, this could be the end as well for a wave Y, WXY up. But if price does move down, take this low, we still have this bullish CVD divergence as well, where the target in both cases is taking that high. If we then look at the probabilities of the different scenarios, then on the low time frame, we are keeping an eye on weakness for a potential retracement here, as currently the probabilities are a little bit higher for price to retrace back into the range, right? That is then also the number 1 over here. But a close 2 is also the double 1-2, preferably over the ending diagonal, to be honest. Maybe I should have put double 1-2 on the left and ending diagonal on the right, where we really have to observe the reaction if price does move to the upside and the 886 probabilities play out. Really have to observe the reaction here. If price moves to the upside on very high volume, right, big candles, we could expect potential continuation. Also, we have resistance right above the double top that we have over here, right, the golden box. So be careful about that one, where we could expect at least some resistance, but the reaction is going to decide continuation or a move back into the range, where currently the probabilities would be higher to still see a bit of a retracement and stay in this range for a little bit longer. And on the micro, the probabilities would be higher to take the highs because of the amount of time we have now spent below the 886 and the amount of times we also hit the 886. But losing the golden pocket here and moving below this order block here could increase the probabilities for a move to the downside or this potential diagonal over here. I hope that this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use, in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.